Hi, and welcome to this week's Market Insights. Now, markets have seen heightened volatility in recent sessions, particularly across Asia, and attention is now shifting towards a series of key macroeconomic releases from the UK and the US that could shape some short-term direction. So let's review recent market developments and outline the main catalysts for the days ahead. Now, Asian markets were a key focus in recent days, with the Japanese yen and domestic equity indices attracting the most attention. Japan's ruling Liberal Democrat Party secured an outright majority in the lower house election, providing some political continuity and reinforcing expectations around policy stability. So equity investors responded pretty positively to that result. The Nikkei extended its rally and reached record highs, with the index already up more than 15% year to date. A Japanese yen also strengthened. Despite some earlier expectations of some potential post-election weakness, the move was driven primarily by positioning adjustments, shifting monetary policy expectations and intervention dynamics rather than a straightforward political reaction. Now, although the long-term uptrend in pairs such as US dollar, Japanese yen and euro yen appears to be under pressure, it's still premature to confirm a sustained bearish reversal. For now, the yen is supported by solid fundamentals, but additional catalysts will be required to maintain momentum over the medium term. Now, so with the yen dynamic stabilising for now, the next key drivers will come from the UK and US data calendar, where several releases could prompt some sharp intraday moves. Okay, so in the UK, sterling remains sensitive to both domestic data and US dollar dynamics. Much of the recent movement in cable, that's the Great British Pound against the US dollar, has been driven by dollar weakness, with the greenback, still struggling to recover from that late January sell-off that we had. Geopolitical risk premiums have eased slightly, yet the US dollar has not regained traction, allowing sterling to hold relatively firm levels. Euro sterling now is currently in a correction phase. The euro lacks strong supporting catalysts, while the pound remains relatively resilient. In the absence of major eurozone releases in the near term, sterling may continue to outperform the euro. However, for a stronger bullish continuation in trading and in sterling, the spot 87.20 to spot 87.40 resistance zone remains a key technical area to watch. Now, several UK macro releases could trigger significant intraday volatility. And the first of those is the UK unemployment rate, and that's due on the 17th of Feb at 9 AM GMT +2. The previous reading stood at 5.1% for the 3 months to November 2025, unchanged from the prior period and slightly above expectations. The rate remained at its highest level since the 3 months to March 2021. Although the unemployment rate came in slightly above forecast, it remained unchanged from the previous month. Markets had been positioned for a further deterioration in the UK labour market, so the lack of additional weakening was interpreted as relatively supportive for sterling. As a result, the pound saw a short-term strengthening following that release. Any deviation from forecast in the upcoming release could generate a sharper than usual market reaction in Great British Pound pairs. Following that, we've got the UK inflation report on the 18th of Feb at 9 AM GMT +2. Now, in December, a CPI rose to 3.4%, exceeding both the prior reading and expectations. This year-end acceleration, in fact, was the first one since last July. The uptick reinforced concerns that inflation remains above the Bank of England's 2% target, supporting the British pound in the short term for sure. Now, if inflation continues to accelerate, it could challenge the Bank of England's relatively cautious policy outlook. Markets are currently pricing in only one rate cut this year, but persistent inflation pressure may force a reassessment of that path. Now we'll turn our attention to the US, and the dollar, as we've mentioned, has been struggling to regain momentum following that sharp sell-off at the end of January. While there are limited fundamental drivers for a sustained US dollar recovery at this stage, again, incoming macroeconomic data could generate some short-term volatility and some price movements. The key release to watch out for is the PCE price index, scheduled for the 20th of February at 3:30 PM GMT +2. The previous reading came in at 2.8%, slightly higher than the prior month and broadly in line with expectations, while monthly readings remain steady steady and also matched forecasts. Now, according to current market pricing, the Fed Reserve is unlikely to begin cutting rates before June of this year. Nevertheless, inflation data remains a critical short-term driver for FX and index markets, and any surprise in the PCE number could prompt a repricing of policy expectations. So overall, this week presents a packed macro calendar with multiple catalysts capable of driving volatility across currencies and indices, such as UK labour and inflation releases, US PCE figures. They all have the potential to generate some relatively sharp intraday moves. Traders are going to remain alert to short-term price swings, particularly in sterling and US dollar pairs, whilst at the same time monitoring positioning in Japanese yen crosses. Staying flexible and focused on macro data surprises will be a very, very good idea navigating the week ahead in terms of heightened market sensitivity. So as usual, don't forget your risk management techniques, and for real-time updates and analysis, pop over to the website and check out our news and analysis section. As ever, we wish you luck with your trading in the week ahead. Bye for now.